today I'm doing a bit of a car vlog because I've been on the road quite a lot lately, and I don't really have time to sit down and record the video. So let's try that. Today's topic is earnings before interest and tax. Welcome to my channel. My name is Jacques Taljaard, and usually this is practitioner accounting services, but today it's my car. And on this channel you would usually find discussions of videos of an informative nature on topics of accounting and tax to assist business owners in South Africa. And today's topic is earnings before interest and tax. Now, recently I've spoken about you went into business to make money, and as a result, making money, how do you know when you are making that money? Now, the easiest way to know whether you're making money is to look at your net profit. But depending on your business structure, if you want to grow your business and make more money, there are a couple of things that you need to look at. One of them is your EBIT. Now, EBIT is earnings before interest and tax. Why is that important? Firstly, because tax can be managed with good tax planning. You can reduce the amount of tax, but reducing your amount of tax means you're making less money. So tax is unavoidable, and depending on where you are in the circumstances, it could be variable. Then interest has a direct implication, or is directly linked to the amount of liabilities you have, your capital finance, your capex. Now, interest is something that can literally be managed as well, and it can be manipulated. The more interest you have, the more you can deduct from your tax, but it also means the more you have to pay back, and this could have a cash flow implication. So in order to know whether a business is actually making money, you want to know whether the business model in itself is profitable. And in order to do that, you would need to look at your earnings before interest and tax, because you could receive interest income, but you also have to pay interest and you have to pay tax. And as a result, these two figures could have an impact on your net profit, on your bottom line. But there is another option, your earnings before interest, tax, depreciation and amortization, which also removes all of your capital expenditures and your capital payments and gives you a fairer amount of what your operations are generating, in terms of what your operations are bringing in and how much money your business is making. And you want to improve your earnings before interest, tax, depreciation and amortization as much as you can, because if you can increase that figure, usually you will have much more money available to you in terms of making money. So you'll have much more money available for you to apply in using and generating more assets, which will in turn again generate more income. But you will also have more money available to service your debts. You'll have more money available for salaries, for the shareholder salary. It will be more money available for expansion. All of these options become available if you're able to increase your EBITDA or EBITDA. And that is why you want to take a look at your earnings before interest, tax, depreciation and amortization. My name is Jacques Taljaard. This is usually practitioner accounting services, and I hope you have a great weekend.